Imagine walking into a bank in 1933, not a giant glass building, not a modern lobby with screens and cameras. A smaller bank, a neighborhood bank, the kind of place where the teller knows your name, where farmers deposit money after a harvest, where families stored every dollar they believed was safe from rent, sickness, and old age. Now imagine a crowd outside. At first, it is only a line, then the line becomes a rumor, then the rumor becomes a panic. Someone says the bank is out of cash. Someone else says another bank failed yesterday. A man near the door says he is only withdrawing his money to be safe, and that is the problem. Everyone is only trying to be safe. No one in that line thinks they are destroying the bank. They are doing something that feels completely rational, getting their own money before it disappears. But if enough people do that at the same time, the bank can fail even if it might have survived. This is the strange psychology of a financial crisis. Fear does not need to be false to be dangerous. Sometimes fear becomes dangerous because it is partly true. At this point, the Great Depression moves beyond the scope of a simple stock market crash. The usual version is simple. The 1920s were wild. Wall Street got greedy, the market crashed, and the disaster followed. That version is incomplete. The stock market crash was the spark people remembered because it was visible. It gave the disaster a date, a symbol, and a sound. Ticker tape, shouting brokers, fortunes vanishing on paper. But the roots were deeper. The American economy had been built into a fragile machine, powered by credit, speculation, weak banks, and a global monetary system that treated gold as more sacred than employment. When the machine started to break, the institutions meant to stabilize it often made it worse. The Great Depression grew from a system incapable of absorbing fear, a far more significant cause than any single bad day in October 1929. To understand that system, we have to begin before the crash. The 1920s boom was not a complete illusion. America seemed to be entering a new age of permanent prosperity. Cars rolled off assembly lines, radios entered living rooms, manufacturing expanded, productivity rose. For many urban Americans, the decade felt like proof that the old limits had been broken. But booms have a dangerous talent. They make strength easy to see and weakness easy to ignore. The prosperity was uneven. Farmers had been struggling for years, trapped by debts taken on during better times. Industrial wages did not always rise fast enough to let ordinary people buy everything being produced without borrowing. Credit helped the decade feel richer than it really was. Credit moves the future into the present. A family can enjoy a radio before finishing the payments. An investor can buy more stock than their own money would allow. For a while, everyone feels wealthier because tomorrow has been pulled forward. The hidden condition is that tomorrow must arrive as expected. If confidence remains intact, the whole structure appears rational. But if tomorrow is worse than expected, credit changes character. What once felt like opportunity becomes a trap. This was one of the deep vulnerabilities of the 1920s, a prosperity that depended entirely on continuing confidence. In the stock market, that confidence became especially intense. When prices rise long enough, people stop asking whether the price makes sense. They start asking how much they might lose by not joining in. The crowd becomes evidence, the price becomes proof. By 1929, this emotional climate had become dangerous. The Federal Reserve, worried that speculation was being fed by easy credit, raised interest rates. But raising rates slowed business activity and placed pressure on borrowers everywhere. Then the confidence snapped. In late October 1929, the stock market broke. The crash destroyed fortunes. It frightened consumers. It weakened businesses. People who had borrowed to buy stocks were ruined. People who had believed the boom would last were forced to confront how much of it had been built on expectation. Markets crash, bubbles burst, pain follows. But for a recession to become something as destructive as the Great Depression, the shock has to travel deeper. It has to move from Wall Street into farms, factories, households, and local stores. The crash was the broken window. The depression was the house collapsing behind it. By 1930, some observers believed the worst might pass. Then the banking system began to fail. To understand why that mattered, you have to understand what a bank actually is. A bank does not keep every depositor's money in a vault. It lends much of that money out. This system depends on trust. If depositors lose trust all at once, the bank may not have enough cash on hand to satisfy everyone. A bank can be vulnerable not only to insolvency, but to panic. In 1930, bank failures spread. In December, the Bank of United States in New York failed. Despite its name, it was a private commercial bank. But its failure was the largest in American history to that date. When one bank fails, depositors at another bank ask the question that makes banking fragile. What if we are next? The rational response is to withdraw cash. But when everyone does that together, the fear helps create the event everyone fears. This is the bank run. It is panic with a feedback loop. The United States did not yet have federal deposit insurance. If your bank failed, your savings could disappear. This is what made the Depression so destructive. The banking system was the circulatory system of the economy. When banks failed, money vanished from practical use. Deposits disappeared, loans were called in, credit dried up, local economies lost their financial oxygen. The economy was not only poor, it became afraid of itself. Depositors withdrew money, banks reduced lending, and businesses cut payrolls to protect themselves. Each defensive action made sense in isolation. Together, they deepened the collapse. The behavior that protects one person can damage the whole system. The next stage was deflation. Economy-wide deflation during a depression is not a healthy discount. It signals demand, money, and confidence are shrinking together. When prices fall broadly, business revenues fall. If businesses earn less, they cut wages and lay off workers. When workers earn less, they spend less. The cycle tightens. Deflation is especially dangerous because of debt. If a farmer's income drops, his debt does not automatically fall with crop prices. The debt becomes heavier in real terms. Prices fall, income falls, but debts stay fixed. The real burden of debt rises. This systemic collapse of money and credit created a disaster far more severe than a standard recession. To pay debts, people sell assets. But when many people sell at once, prices fall further. Falling prices make debts even harder to pay. More people default. Banks take losses and reduce lending. Output falls. Unemployment rises. If people expect prices to keep falling, they delay spending. If businesses expect lower revenues, they delay investment. Everyone waits. Everyone protects themselves. The economy gets worse because everyone is careful at the same time. Fear slows the movement of money. Slower money creates more fear. Central banks exist partly because financial systems panic. During the Great Depression, the Federal Reserve failed to stop the monetary collapse. Its leaders disagreed about whether failing banks were merely illiquid or truly insolvent. Some misread low interest rates as proof that money was easy, even as the money supply was collapsing. The banking system was allowed to burn. The Fed's failure turned weakness into catastrophe. While the banking system burned, the gold standard made action harder. Under the gold standard, currencies were tied to gold. In theory, gold was the anchor. In practice, it became a cage. To defend gold reserves, central banks often raised interest rates. But raising rates during depression restricts credit and deepens unemployment. Gold felt like discipline, but policymakers clung to the symbol of stability, even as the real economy collapsed underneath it. The global collapse occurred as various national mistakes interacted, rather than everyone stumbling at the same moment. American lending supported parts of the international system. When it tightened, pressure traveled outward. Countries responded with protectionist tariffs like Smoot-Hawley, which led to immediate retaliation and frozen trade. A tariff can feel like a shield, but if every country raises a shield at once, the world becomes a room full of closed doors. Fear pushed nations toward policies that reduced the total space for recovery. The world economy failed socially. Countries stopped trusting one another enough to keep the system open. Herbert Hoover's failure was a tragedy of attempting to fix a systemic crisis with limited tools. He believed in local responsibility, voluntary coordination, and balanced budgets. But local relief could not handle national unemployment. Private charity could not replace lost income across millions of households. Many leaders believed restoring budget balance would restore confidence, but in a depression, restraint can signal abandonment. Hoover's assumptions were built for a smaller emergency. The economy needed a floor. Hoover kept trying to repair the ceiling. By early 1933, the banking system was losing the public's belief that it could function. When Franklin D. Roosevelt took office, he declared a national bank holiday. This was a blunt force psychological shock designed to physically halt the panic. It stopped the run long enough for the government to signal that the system would not be allowed to disintegrate. Then came structural changes. The United States moved away from gold constraints and created federal deposit insurance. Deposit insurance changed depositor psychology. If people believed their savings were protected, they had less reason to run. Recovery became possible when leaders stopped treating the old rules as untouchable. Private fear had become too widespread for private confidence to repair itself. Reassurance had to be backed by credible action. Recovery required providing credible structure instead of simply trying to restore public confidence with optimism. A fragile credit boom, a speculative crash, weak banks, debt deflation, and rigid institutional rules all interacted to accelerate the fall. Each defensive move became another downward push. Everyone tried to survive the fall, and by trying to survive separately, they made the fall deeper together. GDP and unemployment are charts, but the experience was eviction notices, lost farms, and empty tables. The Great Depression represented a failure of imagination as much as a failure of economics. Leaders could imagine the danger of gold leaving the vault better than workers losing their livelihoods. The crisis revealed that modern capitalism had become too interconnected for panic to be treated as a local problem. A government that waited for confidence to return could accidentally prove that no one was coming. Recovery centered on the slow rebuilding of trust, a goal far more significant than simply raising output numbers. Trust is rebuilt by structure. When trust breaks, everything that once seemed solid becomes conditional. In the early 1930s, fear organized everything: households, banks, businesses, and governments. Ultimately, the Great Depression demonstrated that confidence is a structure rather than a mood, a lesson that costs the markets everything. Prosperity is coordination. Millions of strangers have to trust one another to deposit, lend, hire, and buy. Fear found every weak point in the system, exploiting a vulnerability far deeper than a market crash, and the system for too long had no way to stop it.